Well, hello, everyone. Thank you for joining us today for our show with Aaron Perman of S3 Ventures in Austin. So, welcome, Aaron. How are you?
I'm doing well. It's great to be here. I'm happy to.
Good, good. Excellent, excellent. So, I'm going to do a little introduction of Aaron so everyone knows who he is. And I'll also introduce our regular series, Ask a VC series, which we've been doing since April 2020 when COVID hit, because we were doing live events and now we're doing online events mainly. And it's been a fun journey because we've had everyone from Tim Draper to Steve Case to John Chambers on the show. We've had people from London, Israel, Beijing, Hong Kong, Shanghai, India, you name it, they've been on the show. So it's great to do the online VC show because we can get people from around the world. And lately, we have been focused on Texas quite a bit this spring. Partly that's because of my new book, Silicon Heartland. It's one of my series of books on tech innovation in emerging markets. And I consider Texas to be the heartland and be part of this whole emerging story. So Texas this spring, we had a few weeks ago ATX with Chris Schonk, and today we have Aaron from S3 VC, and we're having Silverton soon, May 23rd. So this is our Texas series, and the reason we're focused on Texas is so much is because it's hot. Austin's sixth largest VC hub in the United States now, after, of course, Silicon Valley, New York, Boston, and a few other places. But Austin is on the rise. So that was Chris. And if you want to check out the show with Chris, it is on our YouTube channel at Silicon Global Online, and you can check it out there. And today we have Aaron, and I'm going to do a little introduction of Aaron now. He's a partner at S3 Ventures in Austin. He grew up in DC. He moved to Austin from LA, where I understand he was doing a lot of Asia and Europe deals. So that's challenging from LA. He joined S3 VC in 2013. It's his dream job. He's a board member at a couple of their tech startups. He's got an active deal portfolio. He previously was working in hedge funds. He was working as an analyst. He started his own business, which he ran for quite some time. When he was in college, he did a lot of entrepreneurial activities, which I hope that you'll ask about because some of them are pretty interesting. He also got involved in oil and gas hedge funds. So look, it's quite a varied background. He has a Bachelor of Science in International Business from USC, and that's Aaron, what I know about him. Okay, now S3 Ventures was founded in 2007. It's the largest VC firm in Texas. It's investing in startups in tech, primarily business tech, health tech, consumer digital tech. The firm has 60 plus investments, a score of excess more than 20. One of its best deals, or I think its best deal, was Alchemy, which went public a few years ago. I counted up the number of acquisitions that the firm has done. It's 19, according to the website. Now, Aaron may correct me on that. $900 million in assets. There is a single LP, believe it or not, a single LP, a philanthropic investor who is also from the Heartland. Okay, and S3 Ventures is investing in Texas. Okay, now it's your turn to ask a few questions before I dive in and start asking Aaron. If you hesitate, I'm going to jump right in and begin to grill Aaron. So, all right, who has a question?
Okay, I'll jump in. Aaron's background says he wrote code. I know five languages. The last one I learned was Python. Which code do you know?
Let's see. Early days Java. I actually wrote a little Python a long time ago. Did like different stuff in Visual Basic and web services back in the day when that was a thing. So, in all honesty, it's been 10, 15 years, but spent a few years internships and other things writing software.
Okay, so the easy thing is the 20th century when it's linear. The hard thing is to program a quantum computer. During COVID, I got special permission from IBM to use their computer, 57-qubit computer. Trying to program a quantum computer gave me headaches. Do you know anyone else who programmed a quantum computer?
I would go take a look at the folks over at StrangeWorks.
StrangeWorks? Okay, thank you. That's my
All
question.
right. Okay, Ray, how about you? Do you have a question? Or Wyatt? Or Jonathan? It's your
Yeah,
turn.
yes, my name's Jonathan.
Hey,
Howdy,
nice to meet
everybody. Aaron, thanks for joining us here today. I'm currently an MBA student at Texas A&M, and I have a question about kind of like your Texas basis. So, like,
you.
given that S3 like focuses on Texas-based startups and your significant like experience in the region, how do you take on like unique challenges and opportunity for like early stage companies in Texas compared to like other startup ecosystems, and how does it like kind of steer your investment strategy?
Yeah, it's a great question. So, I mean, I think there's a few things. Like, I think in general for early stage companies, and maybe let me start with investment strategy first, actually. So, why are we focused on Texas as well as, we'll invest in the middle of the US. So we really just don't invest in California and New York. And probably 65-ish% of our companies are in Texas. The remainder are spread out from, Portland to New Orleans to Atlanta to Chicago. But well, all those markets have in common is, we think either they're better places to build businesses, cost of living's less expensive. And so, most people that are working at startups are not, don't have big company salaries. And so, that way, they can afford to basically go work at a startup. I mean, it's really hard to do that living in SF these days. It means the startups can be more capital efficient. So because of that, they need to raise less money. And then specifically in Texas, we can be more helpful. And so, we have a lot of networks here. And so those networks allow us to better help our companies to hire talent, to attract customers. And when a startup needs a, executive or their first salesperson, or they usually needed them like 3 months ago by the time they're hiring them. And so that speed to network is really, really valuable. And then, the third thing just candidly is why are we so lucky if we're seeing a deal in SF that reaches out to us cold that, has 100 venture firms within 2 miles of them. Is there something we're missing? And so we can use our networks around here to kind of diligence better. And so that's a lot of around the Texas focus, but there is just a broad firm thesis that Texas and the middle of the US are generally underinvested relative to the coasts, and they're actually better places to build businesses. And Texas, you have a lot of engineers, you got a lot of great talent here, and we think this can be a really great market. In terms of the unique things about companies in Texas, I think I hit on one of them already, like why it's beneficial to build a business here. I think the other thing is it's just kind of a down to earth and friendly community. You can reach out to most people via cold email or LinkedIn, and most people respond. And most people will work together. And a lot of the the investment firms, we obviously compete with each other, but we also like to co-invest. And we might lose one deal to another firm, and then the next week we're having a beer with them and saying one of the partners there and saying no big deal, we'll work on the next one together. And so it's just a kind of friendly collaborative community. That's something I think from a challenge standpoint, we have a great talent pool, and especially in the last 3 to 5 years, it's easier and easier to convince someone to move to Austin. It's typically not a hard sell, especially in Austin, to be like, hey, move here from SF or move here from New York. Like, you don't really have to do that much convincing. But there are certain subsectors of talent that just by virtue of being bigger ecosystems, some of the deep AI talent and other things like that you might just see more depth of in SF, for instance. But people will move here. And I think from a overall Texas, it is a lot easier to attract coastal talent to Austin than it is to Houston or Dallas. And so I'd say most of our software portfolios in Austin, we've had a couple great software companies like Alchemy that went public in Dallas. And they absolutely build big software companies there. But we have found with some of the companies that we have to say that maybe were started in Houston, they opened dual Austin and Houston headquarters because there's a bigger depth of especially startup kind of tech talent in Austin. So that the depth of talent is a little bit uneven depending on the cities, as well as the ability to convince someone to move there from the coast.
Yeah,
Thank you. I appreciate it.
Yeah, that's a very good answer. We definitely have seen this migration from Silicon Valley and other tech hubs to Austin. And it's interesting that you mentioned that Austin is kind of an easier place to get people to move to than Dallas or Houston. Could you amplify on that answer?
First off, Dallas and Houston are great cities. Like Houston is more diverse than Manhattan and has the best types of food of anywhere. And Dallas has a lot going for it too. So I'm a big fan of all the big Texas cities, but I think Austin kind of just still has this sort of keep it weird coolness about it. That and is a hub of other tech talent. I do think there's more density of startups and tech people and startup people and capital here. Not all, but a lot of the venture capital firms in Texas are based in Austin. And there's some great ones, Mercury Fund out in Houston and some great ones in Dallas too. But you got probably 5 times more in Austin. That it just if you're in SF and you're thinking of leaving and thinking of taking a role and want to get away from a coast, you look at Austin as a city where you could live for the next decade. And hey, if that role doesn't work out, there's 5 other companies, or there's a whole bunch of VCs that could go raise money from. And so I think just from Austin's been de-risked in a way. Some of the other Texas cities have not as much from a critical mass standpoint of a long-term career move. And it just has that kind of coolness factor that I hope we don't lose with all the people coming here.
Yeah, right. Yeah, a lot of new buildings going up. The skyline is rapidly changing.
Last time I was walking down Rainy Street, which with a young daughter, I don't really make it out there anymore unless it's like South by Southwest. I felt like a tourist screaming mug me, where I was just sort of looking up at the skyline and seeing all these the 8 towers and thinking, when did this happen?
Right,
But
right.
it is interesting because I think there's 2 things about that from a macro standpoint. One of the things about Austin, one of the things I loved in 13 when I moved here, it was just so affordable. And the affordability was great because growing up on one coast and moving to another coast, I was living like 10 minutes downtown in a great house, and my street was a just great mix of people from, professionals, white collar, blue collar, what have you. And you really don't have that mix and diversity of people on the coast on a single street in a single neighborhood just because of the cost of living. And so the cost of living in the last decade's gone up dramatically here. And it's kind of sad. It feels like we're losing a little bit of that, losing a little bit of you could afford as a founder not to take a salary for a couple of years if you had a good job before this, because you could rent somewhere that was decent near downtown for $800, $1,000, $1,200 a month, and now it's double that. And so I think what's good about a lot of the residential construction is Austin's actually had the steepest home price fall since the peak, where I think home housing prices have fallen, or at least for purchasing houses, like 20% was what I was reading. And I think that's actually a good thing. And I say this even as a homeowner, that's a good thing, because it sort of takes some of the air out of the just cost of living inflation that could risk some of that sort of benefit of here versus the coast. And I think it's still a huge advantage in Austin versus the coast, but it was closing a little bit. I do think if you look at commercial real estate, like there's been an overbuilding, but again, it was so freaking expensive pre-2019 just to get office space here, that my hope is that actually makes it more affordable to build companies here. And fortunately, I'm not a commercial real estate investor, and so they may take some pain, but I think it'll be good for the ecosystem.
Okay, as long as we're talking about pricing, why don't we talk a little bit about venture capital valuations? What are you seeing right now in Austin, and how does it compare to other tech hubs in the United States?
I think valuations are, for the most part, are national at this point. I mean, in addition to the local firms, like the firms from the Bay Area invest in Austin all the time. And it's not just, 2013, the saying was, if it's under 10 million of equity or 10 million ARR, they'll talk to you all day long, but they never actually write a check. And that's changed. There are seed funds here that, including seed funds we're co-investing in from the Bay Area, is doing seed deals or even like pre-seed deals here, doing Series A's here. And so there's, yeah, I wouldn't be surprised if Austin, the valuations might still be a little lower, 10 or 20%, but I think that's more of a function of you need less capital. And the venture math of you sell X% with every round sort of means you need less capital. So maybe you can have a slightly lower valuation, but it's not a big gap. I mean, for the most part, valuations are national, and hot startups, if they're an attractive market, attractive business, they're going to raise a price competitive round in Austin that's going to be competitive with whatever terms they would get in the Bay Area. I do think that the startups in Austin are a little more down to earth, where there's a bigger focus on building the business, which I think is the right focus. And there's a little less of a focus on, hey, how can I raise that super flashy round? And there's a realism of, and I think a lot of companies lost this in 21 or 22 and are maybe going to regret it and are coming back into it, that, look, no one wants to take extra dilution, but as a founder, there's a realism that it's better for you to raise a round where you're confident you can grow into your valuation and pass it and raise your next round. Because most successful companies will be unprofitable for a decade plus, because it's going to be accretive to just keep reinvesting in growth. And so there's this like fine line where if I'm a founder, I'm going to think like the best possible round I can raise is the highest possible valuation, where I still have confidence from an execution standpoint that I can grow my revenue such that even if things don't go perfect, even if I achieve 80% of what I said I would achieve, I can still grow into and pass and raise my next round at a higher valuation, and not be stuck with a cap table and a post money that prevents me from raising my next round or causes me to get unnecessarily diluted. And so there's a little more realism and kind of salt of the earth on that here, I think, than, I think some of the really high valuation rounds in the Bay Area, especially in 21 or 22, if you look at the companies now, it wasn't good for them because employees are leaving, they're seeing their options are underwater, they can't raise their next financing. And so we got less of that stuff going on here.
Okay, and AI has been a big feeder into those valuation rises. So how many AI type companies are in your portfolio?
So we have a lot of companies in our portfolio that are using AI. And so what I mean by that is, and I think most SaaS companies that call themselves AI companies or SaaS companies that use AI, where if you have a good data schema and you have a good application, it's really, really fast to implement AI functionality. And so we have companies like my portfolio company, Plural, that helps public advocacy professionals, either at enterprises, commercial enterprises, or nonprofits, better track legislation and advocate for bills with some of their workspace tools. Mm-hmm. And so for them, they had the data schema right. And so when LLMs kind of hit the market, they were in month or two able to build things in like an AI bill summarizer that automatically summarizes 300-page pieces of legislation, or summarizes changes as these things change, as they make their way through the House and the Senate. We have other companies like Vidiate that use AI to automate the creation of kind of explainer videos and product video documentation, and then automatically update it as products get updated. And so we have a lot of companies that use AI. We don't have any companies in our portfolio that are either the foundational, large language model layer, or that are the I call like the next sort of infrastructure layer. We have a couple with applications. My portfolio company Riscosity helps third parties helps enterprises get visibility into the third party they're sending data to and from, and then control it and redact it and make sure they're complying with the data privacy agreements. And so within AI, that's a big area of application for them, because one of the big issues with these AI models is sending out PI and confidential data to them and not being able to have some governance and control. So I guess we have a couple that kind of touch the tooling area. But I think if you look at the overall AI value chain, there's a lot of questions on where the value is going to be captured, whether it's at the application layer, whether it's at the tooling layer, or whether it's at the model layer, or do all the cloud providers and one or two independents ultimately own an LLM and effectively give it away for free or on a meter to drive usage of their cloud, right? And that market just moving so fast that in a way, kind of the overnight successes in the LLM world were really invested in like 5 or 10 years ago. Same within the chip world for LLMs. And so we didn't have a focus on that at that time.
Okay. Who do you admire most in the tech world?
It's a great question. Give me more like give me a little more balance.
I don't know, Elon.
I'd actually
This can be international.
I'm thinking
This doesn't have to be Texas.
yeah, no, I'm thinking about that. This is like contrarian to but Satya at CEO of Microsoft. Like, if you were to ask anyone 10 years, 8, 10 years ago, who the key cloud providers, nobody would have said Microsoft.
Yeah.
Everyone would have said, AWS and Google. And somehow, like Microsoft has come from behind to really being probably the number 2 cloud player behind AWS. And all of their kind of, 365, they've made the SaaS transition beautifully. Like that's been quite an impressive transformation.
Yeah, no, I agree. Which VC firm do you most admire from Sand Hill Road?
Oh, I don't know. I've worked with a bunch of VC firms, co-invested in lots of good folks, but I don't think I could give you a hey, that's the one.
How about three?
So 3. All right, let me get back to you on that. I'll think about that. I'll get back to you.
Sequoia, Andreessen Horowitz. Um,
What's interesting about that is there's been 2 models, right? Some of the Sand Hill Road firms really look more have sort of stayed true to being what we think of as a typical venture firm. I mean, anywhere from 10 to 30, 40 people, partners driving deals, and then it's been interesting to watch Andreessen because I think they're up to 500 people now.
wow.
It's almost like it's almost like a big company at this point. And
Yeah.
I think they try to do the nimbleness with having the uh almost like the top level of Andreessen almost being like a fund of funds, and then having the individual managers in their respective spaces do allocation decisions. But it's just kind of interesting. Like they
Yeah.
probably have HR and things like that we don't, and we have a very appropriate workplace, but we look, we don't feel like a big company.
Right. What do you have, about 60 staffers?
No,
About
for us, no, we're 12 investment professionals.
12 in that, but overall the staff is how
Oh no,
large?
it's like we have 2 non, like 14.
14. Oh,
Yeah.
okay. All right. And you have one limited partner. So
Yes.
let me ask you about what are the benefits and the disadvantages of having one limited partner as your investor?
So to me, it's been almost all benefits. I mean, the benefits are we don't have to do a huge fundraising roadshow every 18 months.
Hmm.
We have a lot of flexibility on deployment windows. So if we don't see anything we want to invest in or much we want to invest in for a year, we're not under pressure to deploy our whole fund in 2 years or 3 years, or we have to give it back, right? Or deploy, at least all our initial checks then. We can deploy over 4, 5, 6 years if it makes sense. We don't have a lot of pressure on fund life. Like we have a typical GPLP structure, but we can, if things are working, we can extend the lives of our funds, hold things for longer. We're never a forced seller because a company hasn't been acquired, or gone public. We don't have to worry about continuation funds or any of that. We can kind of just keep funds going. And then we don't ever really run out of reserves because, we do have a typical committed fund, but if things are working, our LP is happy to have us keep investing in them. And so we can keep supporting our companies that are growing and working and doubling down on them for longer. And it really, the reason that we have, almost our whole team is an investment team and we have a very small non-investment staff, is because with the one LP, it just dramatically simplifies everything. We don't need 3 IR people. We don't need, 3 people in finance and back office. We don't need to, comply with every, endowment or pensions preferred reporting metrics. And it just dramatically simplifies things, and it lets us focus more of our time on what we like to and what creates value, which is making good investments and then being more involved with our portfolio companies. And it lets us spend our management fee on things that add value to our portfolio rather than report on them. So for instance, we have a full-time director in talent and network to help our companies make great, executive and mid-level hires. And this is all free to our portfolio. And so, our investment team spends about half the time investing and half the time operationally with companies. We have, associates and VPs that can work on projects for our companies. And again, we don't charge our companies for any of this. And I think we've probably saved our companies at least hundreds of thousands, if not more than that, of recruiting fees with our director of talent, helping them on recruiting in, probably the last 12 months, which is really meaningful when you're an early stage startup. So that's all the benefits. I think the drawback, right, is there's always a risk with concentration. But it's been a great 19-year-long relationship. We've had good returns. They've been fantastic to work with. And so that really hasn't had, ill effects for us. And because we have a typical fund structure, I think we've had the returns needed where if we ever needed to go out and raise from other LPs, we very much could raise a future fund externally as well. So that's sort of de-risked it a little bit, but that's really the only risk in my opinion.
Is that something that the firm might do later on, is open it up to other LPs?
Here's the thing. You open up to other LPs, and even if you have one more LP, all those benefits go away. Your back office complexity, doubles or triples, et cetera, et cetera. And so I think the relationships are great. Who knows what we do in the future. There's no compelling reason to, for the last fund, and we'll just see with the next fund. But so far, historically, we're now on our fund 7, and there hasn't been a reason to do that, I guess is how I would put it.
Yeah, well, you must be delivering the results. Plus, can you talk about the kind of returns that you're getting?
So the other fortunate thing is because of our sole LP, we don't have to disclose a bunch of stuff and keep it updated constantly and share it with PitchBook, which you would have, and share it with, Cambridge Associates and all those, which is what you would have to do if you had a bunch of LPs at institutions. And so we typically don't, not for any reason other than once we start to talk about this, we have to like update it and make sure our numbers are perfect. And so we generally don't disclose specifically, but what I can say is, we've returned a ton of capital, a lot more capital than we've drawn down historically, and have provided very good returns. We've had on our portfolio company, Alchemy went public in April of 21. S3 had led the A, kind of co-led and was a lot of the capital the B. We led the C. Our LP came in with us on the C, and then we did kind of a couple additional rounds of capital after that. General Atlantic had led the D, then we co-invested on the Series E with them. They raised an F and went public, and so that investment alone returned is returning quite a bit of capital. So we've had some great returns, and we had another exit in September of 21 for $500 million, and so it's been you can kind of back solve our AUM versus some of those, and draw your own conclusions, but our returns have been good in my opinion.
Okay, I noticed that a number of your portfolio companies have been acquired rather than go public. Is acquisition a better route, do you think?
So I don't think it's better or worse. Our goal when we make investments is to build great companies. And if you just keep building and building and building and they have a public opportunity, you typically don't want to be a public company with under $1 billion in market cap. Being a small cap company has all the costs and none of the benefits of access to the capital markets that a public company should provide. And so if a company kind of keeps growing and growing and growing and nobody shows up over their life with an offer that we couldn't refuse, and they get to 150 million ARR, we're happy to have more public companies. Sometimes a company, you make an investment and it works, but the thesis doesn't fully play out, and you're not getting to a scale where you could be public, but you could still have a great outcome for the founders, employees, and investors with an M&A exit, and so that can make a lot of sense. Or sometimes maybe you do have that, but you're maybe at a stage where somebody shows up with an offer that nobody can refuse, and the management team and founders look at each other, investors, we all, look at it and say, hey, on a risk-adjusted basis, it makes sense to do this. And so we don't really go into the preconceived idea. I think the vast majority of exits in venture are M&A exits. Our percentage is probably pretty consistent with most firms. And then I think that the last thing to think about is an M&A or an IPO is really just a financing. So when you go public, you're probably selling 5, 10, 15% new shares, something in that order of magnitude. And then, the founders, the management team, the investors, you're all locked up for 6 months. And then even after your lockup ends, if you're a founder that's actively involved with the business, CEO on the board, you're getting liquidity slowly with a 12B1 plan. Like you're probably gonna be in the stock for 5, 10, 15 years even, or at least until you're no longer actively involved. And even then, if you owe a lot, you gotta sell it really slowly. And so it's more of a financing event with like the ability to get a little bit of liquidity over time.
Yeah.
Versus an M&A exit, if it's a cash exit or a mostly cash exit, you're literally getting like a wire the day or the day after it closes.
Yeah. No, I
And so
can
it's
see.
just different.
Yeah. All right. Who else has a question? Are you seeing any Asian investment interest in Texas?
You've Samsung opening a huge chip factory here, but I
Oh
think
yeah,
from
Samsung. Mm-hmm.
I think so from bigger companies, yes. I've talked to a company that will move here from Singapore. Sometimes we've seen companies relocate sometimes.
Yeah.
We haven't seen a lot of Asian venture funds or something
Mm-hmm.
making cross-border investments here. Although I'm sure there are a few at maybe the later stage companies, but not at like the C to Series A stages.
Okay. Um, Robin, I hope you heard that. Um, Robin is here from Invest Hong Kong.
We
And
actually had a co-investment with Horizons. We co-invested with
okay,
them in Level Set. We had led the Series B. They led the Series C, and we did kind of the second biggest check into it before Procore acquired them. And they're a Hong Kong-based investor. So I take that back. We've had one they were in New Orleans actually, but they had a big Austin office. So we had one
sure.
co-investment with a Hong Kong based investor.
Okay, yeah, I know Horizon. That's good. It's a big one. Wyatt, did you want to ask a question? I saw your camera on.
Yeah, I have a question for you. Um, First of all, thank you for speaking with us today, Aaron. I'm also an MBA student here at A&M, and I've actually had the opportunity to talk to some of your team. I've talked to both Kaylin Wright and Carolyn Horan. So I know you have good people working for you, but I wanted to ask about your allocation for your fund. I know you guys invest primarily in business technology, digital experiences, and healthcare technology.
Yeah.
So I kind of want to hear more about the allocation between your three focused business units.
So we don't have a fixed allocation on something in our fund docs, as we have to do this percent each way. I would say historically how it's leaned out, how I think it'll lean going forward is think 80-ish% to business technology and 20% to health to med device and consumer technology. And really what that boils down to is, if you look at the history of Austin and Texas broadly, Austin really got going as a semiconductor city, and then IBM came here in the 90s, brought a bunch of B2B software people. You had some big B2B software wins like Trilogy and Vignette in the late 90s, early 2000s, and a bunch of other companies like that. And so Austin was really more of an enterprise software town. And then in the mid 2000s, you had a couple of things. You had Austin Ventures did some of the big consumer roll-ups like Retail Made Not and HomeAway that started to bring some consumer tech talent. Uh, and uh, and then you had, the big tech companies like, Google and Facebook, when they first moved here, they were really putting like inside sales here, SMB inside sales. And for SMB SaaS businesses, unless your product-led growth, inside sales is half your secret sauce. And so we started to get some more, and then we had some companies like Main Street Hub and other companies like that here that kind of built out an SMB software muscle. And so if you just kind of look at that history, I would say that Austin and Texas in general just has a lot more business software, and so we kind of skew that direction. But over the last decade, our consumer tech ecosystem has grown, and so we've done more and more of that. We were the lead investors in Favor Delivery that was acquired by HEB. They were one of the early food delivery companies, maybe the only one that was of scale and profitable actually before they got acquired, which was might still be unique today. Atmosphere, which is one of our companies, that's TV for business, but it's more of a kind of consumer go to market. Uh, and but we just there isn't less. And then on the med device side, the reason that's less is it's somewhat tragic based on our healthcare system works, but there's a lot of devices out there that can help people, but there's very few device investments that can produce a venture return. And what I mean by that is there's enough people with the indication. We think they're going to get a high enough price point in their CPT code, and the capital to get through FDA relative to their market size works. And so it's just and we used to have less med device in Texas, especially in Austin. There's more in Houston, but less in Austin. And so we've just there have been just fewer venture scale opportunities in the med device world than we see in the software world. And so that's really the rationale behind it. And so, like I said, 80% business software, 20% consumer digital and med device, but it's not fixed. If we saw more of a certain type and less of another one, we can kind of have some play there.
Okay, good
Thank you.
answer. So are your portfolio companies hiring right now? You mentioned recruiting before.
They are. I mean, they're always ebbs and flows, but we got a few are. I recently led an investment. We haven't done a full press release announcement, but it's also not a secret, in a company called Tax. They help companies more accurately comply with their sales and use tax obligations with a modern calculation engine. And so that's been one that I've been doing a lot of hiring for and helping them, bring on a VP of marketing, a VP of finance, an independent board member. And so been involved in some of those recruiting processes. And, then we always have companies hiring different roles. I think our company, Interplay Learning, might be hiring for a few roles. Local Base might be hiring. So I'm just kind of going through the mental list. So fortunately, yes, we got plenty of companies hiring.
Okay. So how do you source your deals? You got the whole state of Texas in front of you, right? The Lone Star State. How do you source these deals in these sectors? Do people come to you, go to them, you go to the universities? How does it all work?
It's a whole mix. So there's truly two flows, and probably half comes equally. One of our flows, we have a very defined outbound process where we want to at least have met with 95% of companies that raise a Series A or a B before they've raised a round, and at least 75% of seed companies. And so we have a process where we scrape different data sources, put them in our CRM, highly qualify them. So is it, and that's a B2B software in Texas. Is it a B2B software company? Is it in Texas? Is it potentially a fit for us? And then we have a process where we make sure we're reaching out, and then we measure ourselves every quarter on how well we're doing and getting in front of things. And we've generally been right around those benchmarks. So that's part of it. And then we do a lot of outbound a lot of marketing and networking and events and things to build relationships, drive inbound deal flows. And so sometimes founders of ours are some of our best source of deal flows, but also just, networking relationships, other things like that. So probably 25 to 50% probably comes from that outbound effort. Another 25 to 50% comes from, more senior relationships. And then there's another bucket that just finds us some way. And we actually people can submit a deal on our website, and we actually do look at and respond to, everything in our purview. So we get, we'll get spam, like we'll get deals in, I don't know, Europe, and we just we're not like, that's so far outside of our box that, like, you could see from our website that we're not a fit, right? Or a Series F stage company. But if you're a seed, Series A, or Series B stage company, and you're based in Texas, and you're a B2B technology company or a consumer digital or health technology company, we would look at, and you apply on our website, we will look at it, and we will generally respond.
Okay. So how busy are you generally? Are you 9 to 5, 9 to 8, working weekends? Just give us an idea what your workflow schedule's like.
Highly cyclical, generally pretty busy, generally scheduled morning to night. And then I get email and research and other stuff done at the late hours, or on airplanes. I think in general, like, this isn't a 40-hour-a-week job, and I do this because I love it. And anyone that's doing this for a decade plus and is in kind of these shoes, like, hopefully they're here. And I think most people are because they really love what they do. And, when you're on the board of a company or invested in a company, you're kind of on call with them 24/7,
Yeah.
365. If I have a founder text me on a Saturday night and it's urgent, I'm gonna step out and give them a call back. And so that's kind of, and then if you're trying to win a deal and there's competing term sheets, sometimes speed is the answer, right? And then once a company raises money, I always think it's like a ticking time bomb because typically they raise 18 to 24 months of runway. They have to grow in and pass their valuation for it to work out well for you or for them. And so there's extreme urgency on helping them find the people they need to do that
Yeah.
and on finding the customers and getting the product out, and you're aligned, you're working with them. And so, I earlier in my career had a role where I was working 6 a.m. to midnight most days and a 8-hour day on Sundays and a few hours on Saturday. And that's not sustainable. It's just not healthy. And so for the most part, none of us want people that work here to do that. Like that's not good. You're not doing your best work then. But you're somewhere between that, and this definitely isn't a 40-hour week job. So 50, 60 hours a week is kind of an average week somewhere in there. And then when you're going through an exit, you are back to working those hours. You're working around the clock because time kills deals, and if it's a good outcome, you want to run through the wall and get it done. And so,
What's the
yeah.
most exciting deal you worked on recently, good or bad? The most exciting.
Oh gosh, yeah, it's interesting. I got some things I'm working on now. I can't quite publicly talk about yet that are exciting in a really good way, one exciting in a not so good way. And so I can't talk. It's the things that are happening right now. It's hard to talk about, but yeah, I've definitely September of 21 is a crazy time. Uh, Top of the market, and we had 3 companies get acquired in like a 45-day window.
Wow.
And one of them, I was helping out with, but I wasn't the primary person. But the other 2 were kind of my deals, and was heavily involved with both of them, and was also getting married, and yeah. May have taken a call between the ceremony and the first dance on one of them. Like it was just a lot. And a board call the morning of the wedding. Like, and so, like I said, it was a Sunday, you kind of just like do what you got to do. But that was definitely exciting. I mean, it was quite a time to return a lot of capital to our LP. In September of 21, and Alchemy had gone public in April of 21. So it's like when you're in those windows of extremely high multiples, you kind of get these limited harvest windows, and you want to just harvest as much as you can. And you can always sleep like the next year. I think after that, I remember just taking like 3 weeks in December off and just sleeping.
Yeah, because you go on adrenaline. When you get into that
Yeah.
cycle, you're going forward on adrenaline and then you crash later. Okay, Jonathan has another question, I think.
I'm not sure why it says Jonat, but Aaron, I appreciate you touching on like AI and the like integration layer of that because that's really interesting, as well as the like unique single LP differentiator that you have. And I also had a question about like your record of successful exits and like the significant amount of like capital that you raise. But beyond like the capital infusion, how do you like approach like value creation? And I guess what roles does your like organizational support for your founders play into that?
I mean, it's like it really depends on what the companies need and the stage. And so like at the early stage, a lot of it is helping them hire find the right people and hire the right people. And sort of like I can fish or I can help them, fish themselves. And a lot of that's getting the right people on the bus. And so it's, a lot of times it might just be a founder or co-founders and some junior folks, and they need help hiring, functional area leaders, right? Like marketing or finance or sales or engineering leaders. And so we can help with that. Yeah, other things that we'll do is like, I mean, I joke I'm really just a recruiter and an SDR. Like I'll just pound my network and find them customers. And usually it's funny, people for whatever reason they'll respond to VCs. I don't know why. But they'll respond to VCs in a way they won't respond to a salesperson or a company sometimes. And so I can do that. And we'll definitely do that. And then, we'll do things from we can help them with, fundraising materials, financial models, stuff like that. We'll cohort analysis, business analytic, kind of those sorts of things. I helped run a rebrand for one of our companies that just needed it, and they didn't have a marketing leader. In the height of 22, had like 2 false starts in hiring one. And I finally said, all right, I've done this before. I'll manage an agency and do it. And so, we're kind of just aligned to do what they need from us. I mean, of course, there's stuff around kind of governance and growing up that we try to help with, but that's why we have a team of 5 associates, senior associates, and VPs, so we can actually crank out projects and work for them in between, and um, uh, do some of that too. And then a lot of it's just being a sounding board for the management teams as they think through big decisions. And I said the final thing is on the exits. I think we can create a lot of value because, gosh, I've been through maybe 10 exits in the last 11 years, and most founders, even if they've been successful, most have been through one other one in their career, maybe 2. Same with CFOs. And so having the comfort of seeing a bunch of knowing when to say no, or knowing when just to say, like, your offer's not interesting, go away, can literally, in the last 3 months of a company's life, change the outcome by 50%, 100%. Because a lot of times the first offer is 50 to 100% below what the buyer is actually willing to pay. And as a founder, that either way is making life-changing money. It can be real. It can be hard to know how to negotiate that. And sure, there are bankers, but like, you never really know which side. I mean, I don't know. There's some great bankers that have high integrity, but sometimes like their incentives aren't always totally aligned with the founders, and it's just we're typically much more aligned with the founders because we have equity in the company, and so that can be somewhere we can add a lot of value, and just also the balance sheet of, if a buyer walks away, we can fund the company and give them confidence to sort of get what they're worth, not take a low ball offer.
Thank
That's
you.
really, yeah, that's really interesting. Thank you for sharing that. Hal Kelman has a question.
Yes, one of your things says biz tech. I know 32 different areas of biz tech. Is one of your areas fintech?
Yeah, so because of our geographic focus, we don't have a strong vertical focus. We've invested in a number of fintech companies actually, but business technology is just a broad catch-all for typically mostly software, but also some more infrastructure layer and tech-enabled services, and fintech can kind of fall into that. But anything that's technology sold to a business would be the broad bucket.
Do you have SaaS companies?
Yeah,
Software
yeah,
as a
plenty.
service?
Yeah.
But none of you want to really name.
Sorry, I can't quite hear
You
you.
broke
Do you
up
want to name
now.
them, or okay?
He said, do you want to name them? Do you know
Yeah,
what
sure.
it,
I mean, they're all also on our website, but
okay,
yeah, I can, like all stacks, RPO, brain check. I'm just scrolling through
okay,
highest,
good enough.
hydraulics, good forces. We got a whole bunch.
Good enough. I
Great, I'll
have another.
check it.
Yeah, good. I have another question. So you started out as an analyst, and so you had all this deep financial background. And I just want to know how that's helped you or disadvantaged you, or how has it impacted your whole career now as a venture capitalist? To help you get into venture capital? Do you use it today? How much of your job is this deep analytical stuff of just finance versus the person? That's my question.
Yeah, so it's funny. Like, I guess my job title when I was at a hedge fund before venture was an analyst, but and like, you did build financial models and things, but it's actually more applicable than people think it was. And the thing is, like, the finance and accounting side of it, it's really not that complicated. Like, the most complicated math is addition, subtraction, maybe multiplication, division. All the calculus and other things I took in college really isn't very relevant. Maybe sometimes it's relevant as you're looking at deeper tech stuff and have to sort of understand how it's working. But for like the investment stuff, the math is quite simple. But really the work I was doing at the hedge fund I was at was fundamental analysis, which was uh, really similar in that I was picking small mid cap companies to invest in, both by analyzing their financials and building out financial models to kind of understand what I thought, to forecast what I thought their business was going to be like, and comparing it to, the expectations of consensus and guidance. But also, I spent a lot of time talking to management teams to assess them and get a feel for them. I was probably talking to 3 to 5 different public company management teams a week, and it was great in my early 20s getting to sort of run those meetings myself, mostly solo, or meeting them, in person in New York or otherwise. I was talking to all their competitors, also on all their competitors' management teams, to build a mosaic to understand what was happening in the ecosystem in the market. I was doing, sometimes first-party market research to better understand the market and consumer tastes and things like that. And so that's all, in a lot of ways similar to the analysis that we do here, where we're, forecasting things, digging into operational data, assessing management teams, assessing markets, sizing markets, understanding competitors. And so, the deep financial analytics, like candidly, like they're not that deep. It's just you're building a three. And I think, you know, like accounting is kind of the language of business. And so in venture, yes, you have to understand how to read a financial statement and model a financial statement, but it's really you're taking your understanding of the business and putting into like a formula, like it's algebra. And so it's kind of just table stakes, but that's not going to necessarily drive the outcome of the company. It's table stakes for me, but to understand and explain it. And the irony is, I actually like the finance and accounting never really clicked for me in college. I think they were 2 of my worst grades in college. Like I think I got B's in them, or maybe B pluses or something. And it really clicked when I was at the hedge fund, and it was put into context of that. That was just the way to quantitatively explain these companies and the businesses that I found interesting.
Okay, so what's the best part of your job? What do you like to do? What's the thing that really,
I
wow,
like
this
just
is
learning. I love getting to learn about all the different things. I love learning about all these different businesses. I love meeting people and learning about what they're building. I love working with them and helping to go build something really valuable and special that can, either make someone's life a little better in their day-to-day at their job with the business software, or, increase the production possibility frontier, let's analyze more data. Like it's exciting and fun. And I don't think I like doing this. I don't know what else I'd do. I guess if I wasn't doing this, maybe I'd go, start an operating business or something. But those are the only 2 things I've kind of done in life that I've professionally that I've liked and been good at. And I don't even know if I'm good at it. I'll know if I'm good at it in like, 5, 10 years when the investments I started to lead 5 years ago start to exit. I could be bad at it. We'll find out.
Oh no, I think I'm pretty sure that you're good at it. So I think you found your calling there. So okay, well, great. We're going to be wrapping up the show now. If anyone has any last comments to make, or any quick comments or questions, and I'll just keep talking otherwise, and I'll wrap up our show. So it's been great talking with all of you. Thank you so much for your questions. Friday happy hour time. And that's a first for us, but maybe it's good. Look, our next show is coming up in a few weeks, and we're going to be turning to Leona's Capital. It's an AI focused fund based in San Francisco, and Jenny Zhao is going to be our venture capital and capitalist on the hot seat, and she's going to be handling our Q&A. She's very deep into AI and the research part of AI, so that's going to be interesting. May 9, mark your calendar, 4 p.m. Eastern Time. If you enjoyed this show, you can join our Silicon Dragon Circle membership, which gets you access to everything we're doing in terms of our events and our online show. We do have a show coming up, an event coming up in New York. If anyone's going to be in New York mid-June, we have a program then. I'll share more details later. But in the meantime, just like to thank you for joining us, and please check out our YouTube channel, where we have numerous videos of our VC show on the channel at Silicon Global Online. So thank you again for joining us. Thanks to Invest Hong Kong for the series support. And yeah, we'll see you next time. Aaron, any final words from you?
No, thanks all. It's just good to chat with you today. I had a lot of fun.
Yeah, good. All right. Well, thanks you. Take
All right,
care.
bye.
Bye-bye.